It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today again is smartest guy in the room, Michael Becker.
Hey, Paul.
Better known as the mayor of Beckerville. Hello, Mr. Mayor. How are you?
Doing well.
It sounds so prestigious. Michael, who has owned over 5,200 apartment units in the Dallas-Fort Worth area,
Yep.
up to his eyeballs in non-recourse debt. You must feel pretty good with the rising interest rates that you made the right call.
I feel I've been feeling dumb for a couple of years that we've been taking long-term fixed rate debt out, and everyone else that's making floating rate debt has been winning. But I think the tides are maybe turning a little bit, and our decision might look wise in the rearview mirror now.
I love it. So we don't want to forget a couple conferences that are coming up here. And Michael, I'll turn it over to you.
Yeah. The first thing certainly that we'll have coming up, we've mentioned a couple times now, on March 28th at 7 p.m. Doors will open at 6 at the Grapevine Convention Center near DFW Airport. We're going to have Dr. Mark Dartsauer, the former chief economist for the Texas A&M Real Estate Center. Very entertaining, very funny. I guess I would dare say an economist is funny. That would be Dr. Dartsauer.
Well, this one is,
yeah,
at least.
This one is, right? So Paul is gracious enough to subsidize his large speaker fee, and we're going to offer that free. So if you guys go to the Old Capital Podcast website, which is www.oldcapitalpodcast.com, there you can sign up, and we do ask that you do register to be able to come and attend, but it is free. Certainly don't want to miss that. The networking starts at 6, so we'll have, I think well north of 400 people come show up if last year is any sort of indication. And then our last speaker series on February 15th, we had, well north of almost 300 people at that one. So it'll be a well-attended event. And then we're now, I think, finally able to announce that we have the Old Capital second annual Old Capital Conference coming up, and that's on September the 13th, Paul.
That is correct.
And that'll be an all-day event. I think I'm not sure exactly what time we're going to start, but probably around 9 a.m. That's going to be at the AT&T Stadium, which is where the Dallas Cowboys play. So we have some future speaker announcements coming up, but we plan on having a real nice keynote speaker out there. And we think we'll have, last year we had well north of 400, almost 450 people at that. This year, I think we'll get almost 700 people. So that's going to be a great event. And you can also find some information on how to get tickets at the same website, the oldcapitalpodcast.com. That one is not a free event. So if you do sign up now, you do get a little break. We have some early bird pricing out there right now. And we do plan on having that ticket price go up as we get closer to the event. So I think that's enough plugging for now, Paul. What was the question for today?
The question for today on Ask Mike Monday is, Mike, I've been asked to be a KP, a key principal in a transaction. What do I need to know?
So KP, key principal, we've talked about that concept multiple times on previous podcasts, but basically what that is when you get a Fannie Mae or Freddie Mac loan, you sign what's commonly referred to as bad boy carve-outs. So that is basically these loans are non-recourse loans unless you or one of the members of the management team commit a bad boy act like fraud or misrepresent something, and then the lender can spring in a guarantee. So we call that KP or key principal. So what do you need to know? That certainly signing on a non-recourse loan is far less risky than signing on a full joint and several personal guarantee, as if you're going to like a bank loan and getting a recourse loan. But with that said, there's certainly some level of risk, especially if you're not the one in charge of the transaction. You're just a KP. You're not the actual lead of the deal. So make sure when you're evaluating whether you should do that. I guess we could look at two ways. What are the benefits of doing it? As we constantly talk about on previous episodes, how it's kind of like your way into the country club. So if you want to go and you're an aspiring deal lead, a syndicate or a sponsor of a deal, you want to be able to go get non-recourse Fannie Mae or Freddie Mac debt. Signing on someone else's loan is kind of the way of getting sponsored in the country club. Once you do that, you kind of got checked. You're in the club, and then when you're ready to go do your transaction, several months down the road, you have the relevant experience, and on your first transaction, you could qualify for non-recourse debt. So there's certainly some benefits to it. It's definitely a resume builder. On the other side, there's certainly some level of risk in there. I don't think a lot of people always fully understand. It's called a bad boy carve out for a reason. So if you do happen to sign on a loan and the sponsor of the deal does some sort of bad boy act, they don't do the financial reporting, they commit fraud, they take some insurance proceeds, don't tell the lender about it, acts along those lines, it does have the possibility of springing in recourse, and we have seen loans that we've made at Old Capital where that has happened. So, first and foremost, I think you should make sure you fully understand and vet and do the best of your ability to make sure you're with a good character lead. So make sure that you don't have any sort of like integrity issues on the people you can assign with. That'd be the first thing I would do. Make sure you fully are comfortable with the transaction that you're signing on, that you believe in the metrics of the deal. And then finally, a lot of times, there should be some sort of compensation. Generally speaking, is what we see out of the sponsor compensation. There should be, a small percentage of that carved off for the people that sign as KPs. That's typically customary. Not always the case, but it is relatively customary in the marketplace to get, some sort of compensation, whether that's a fee and or maybe some additional ownership for signing on the note. So that's kind of my general thoughts, Paul.
So when you sign as a KP and you want to do your own deal down the road, how many transactions on the front side should you sign as a KP?
Really just need one, but with that, there's probably a caveat that it needs to be of similar size or bigger than what the transaction you're looking to do. So if you sign on a small balance loan on a 30-unit apartment complex or something on the Fannie or the Freddie small balance side, and then you go try to do a 300-unit deal on your first deal and no one else on your team has multifamily experience besides you, that's going to be a little bit of a tougher sell for us to Fannie Mae or Freddie Mac. So, of similar size, but if you're going to sign on a 100-unit deal and then you try to go out and do a 140 or 150-unit transaction, that works.
So tell me on the flip side of the transaction. So does being a KP, does that show up on your credit report?
It does not, right? So when you're filling out, certainly it's not on a credit report. It's not even a contingent liability because it is a non-recourse loan. It's just the carve out. But, you can put that on your SREO, your schedule of real estate own, and you certainly get credit for that from that standpoint. But when you're filling a PFS out, you do not need to report it. Generally speaking, you do not need to report this as a contingent liability. So this is not something that could potentially cloud your balance sheet as you go out and try to get, future debt. It's not like I said, when you sign recourse, I like to say it kind of clouds your balance sheet. So this does not do that. So you should be free to get more and more debt without any sort of repercussions of having the carve out.
Give me an idea what a contingent liability is. Some people that have never done commercial real estate, commercial banking, they really don't know what a contingent liability is.
Yeah, so contingent liability is if you go to just say like a regional community bank and you go get a loan. So you form an entity, you buy a piece of real estate, and that is the borrower with the loan, and then you come sign as your personal guarantee on it. When you sign that personal guarantee, that creates what we call a contingent liability. So meaning that you're not directly liable at it. You're not the borrower individually, because the LLC that owns the real estate and is the borrower of the loan is the borrower, but your guarantee creates a contingent liability. So if there's potentially a problem on the real estate, on the transaction, then you, by signing that guarantee, are liable to make the bank whole in the event of a default. So that's what we call contingent liability.
And what happens if the property defaults?
Then the bank can foreclose on the property and sell it. And if there's some sort of deficiencies when they sell it, which would most likely be the case if they foreclose, otherwise you would just sell it yourself and not let it go to foreclosure. Any sort of deficiency on there, the bank can sue you to collect for that. Or if there's multiple people, they can sue all of you to collect on it if it's joint and several.
Right. So if you had, let's say, a $2 million purchase price and you were putting down, say, 20 or 30% of the deal. So you are putting in fresh equity into the transaction. So let's say the loan is going to be for, $1 million,
$1.5.
Yeah,
right?
$1 million, 1.5, 1.6. So you'd have to blow through all that equity from the $2 million down to the 1.5 to have a problem. And then if they couldn't sell the property for 1.5, then you would have a remaining balance that would have to be made whole for the bank.
Yeah, so if they that scenario, you have $1.5 million loan. If they sell the property for $1.2 million, so you'll be responsible for that $300,000 delta plus all their legal bills and collection costs. So whatever that would be, then the bank can take that amount of money and then sue. If there's multiple guarantors, they can sue one of you for it or all of you for it.
Yeah, whoever has
they usually start with the rich guy.
Yeah, whoever has the biggest bullseye in their back
is the richest guy in that deal. So if you sign it, you might not want to be the richest guy.
So that's probably the reason why you don't have a lot of contingent liabilities. And
that is the reason why I don't have any contingent liabilities.
So, but everybody that's starting off typically has to maybe have either do a bank loan or do a small balance Freddie Mac loan or sign on a deal that somebody else has signed with you just to to check that box.
Today there's so much more availability of lending than when I started in the business from a principal standpoint, where back then you either definitely had to have someone that had previous multifamily ownership experience sign on the loan with you, which was the route I did. So I had someone else from experience sign as a KP on my loan. That's how we got it done. But back, post-recession, or 2009 kind of on, when the lending started going back, I guess really 2010 and on, most people had to go to get bank recourse when they were starting out. Now there's a Freddie Mac small balance. There's a whole lot of other options that we didn't have, 6, 7, 8 years ago. So it's certainly a good time to be a borrower. There's certainly a lot of available financing options out there that are far more attractive than when I first started out borrowing money buying apartment complexes.
Sounds great. Some great information. Anything else we should be sharing?
That's really it. Again, go to oldcapitalpodcast.com. There you can sign up for the March 28th speaker series, and now we'll have the September 13th Old Capital Conference, which will be the event of the year for sure.
It always is. So if somebody wanted to know a little bit more about what you do, Michael, in your syndication real estate business of buying multifamily properties, what's the best way for somebody to get a hold of you?
Yeah, the easiest way to find more information about my company, SPI Advisory, is just go to our website, which is www.spiadvisory.com. That's SPI like spy, advisory.com. And there's a contact us form. You fill that out, and I'm always happy to have a 10 or 15-minute telephone call with listeners of the podcast to kind of give a little bit more information about what we do.
That sounds great. Thanks for sitting in the podcast. That was Michael Becker, smartest guy in the room. I'm Paul Peebles. Have a great day.